Hello, welcome to Accounting Hub. I'm Professor George Scarping, PhD in accounting, and our topic today is finance lease or sales type lease. What is this? We have our lease classification here. So for the lessee, for the one who is under quote here purchasing it or leasing it, we have finance lease. That's what our video calls finance lease, and operating lease. For the lessor, the one who is selling. This one we have, when we have finance lease, we have the sales type lease. So we call it sales type lease. And we have it without selling profit and with selling profit. We will see both. So let's go to our Excel file. The Excel file, they are free. And the link to download it is in our video description. Okay. So let's consider here, on January 1st, 2020, Scarping Corporation, my fake company, leased production equipment from First Lease Corp. First Lease Corp purchased the equipment from Santiago Corporation. Santiago is the last name of my wife, so it's her fake company, at a cost of $479,000. The lease agreement specifies 6 annual payments of $100,000 beginning January 1st, 2020. uh, the beginning of the lease, and each December 31st from 2020 through 2024. The 6 year lease term ending December 31st, 2024 is equal to the estimated useful life. So here we have a finance lease equal to estimated useful life. And by the way, that classification that we have it earlier, it is valid only in the US, only with US GAAP. IFRS, we don't have operating lease anymore. Okay. The interest rate on this finance arrangement is 10%. So what do we need to do first? To find the present value of these payments. The lease payable will not be $600,000. How do we do this present value? Function, present value. By the way, if you have questions about present value, we have a video about that, and the video is in our video description, as well as a video about the lease classification according to the US GAAP. Okay, so here rate 10%, period 6 years, PMT, our payments 100, and type 1, our first payment is at the beginning of each period. So it is the same for 79. So, okay, the lease is doing, considering the same amount of the present value. So, again, a finance lease. Our journal entry, right of use asset. We don't debit equipment here because we don't have the equipment. We are not the owner. We have the right of use asset. And lease payable for 79. And we need a amortization schedule. So lease obligation. We have the uh, 479. Year zero, our payments $100,000. $100,000 here. Lease obligation, lease less the reduction of obligation. Interest expense, first year, nothing. Reduction will be lease payment less interest expense. And the lease interest expense is 379 times the interest rate. And here we have our amortization schedule. And ending balance, nothing. And we also have a video about amortization schedule, and it is in our video description. So a lot of video in our video description. And okay, we are paying it. So after the year one, so let's consider year one here for our journal entry. Interest expense, 37. Lease payable, 62, and cash 100. And here the sum $100,000. So our journal entry is balanced. And we need to amortize these right of use asset. How do we do that? We just like any other amortization, the right of use asset or our present value here divided by service life. 6 year lease is equal to the estimated useful life. So our useful life is 6 years. And our credit, remember, we don't have accumulated amortization. So our credit is in the asset. So here we have the lessee. What about the lessor? Lease lease receivable, PV, equipment, the same because the equipment here is the 479. Okay, so here we have no problem at all. So we don't have any info about any selling here. Receivement is the opposite of this journal entry here. So we debit cash 100. We credit lease receivable 62. We credit interest revenue. So here instead of expense we have revenue, instead of payable we have receivable. What about the amortization of right of use asset? No journal entry because we are crediting equipment here. So the lessor doesn't have the equipment anymore. So we don't have to depreciate it or amortize it. So this is when we have no selling profit. The only profit or the only revenue that the lessor has is the interest revenue. What if we have revenue or we have profits? So the same lease, however, First Lease Corp or Santiago Corporation manufactured the equipment at a cost of $300,000. So this is how much the First Lease Corp purchased it. So here we have a profit. So for the lessee, nothing changes. Exactly the same. For the lessor, what do we have? Lease receivable 479. We are good. And we have here, it is our sales revenue. The same for 79. How much is our cost of goods sold? Our cost of goods sold is $300,000. We don't have this number in any cell, so let's type it. And it is our credit on equipment because we purchased it for $300,000. We are selling it, so we have our revenue and cost of goods sold. Everything else is the same. Another way to think about this journal entry here is lease receivable 479. Comparing with the no selling profits, equipment 479, but now equipment is $300,000. It is not balanced. If we were selling a regular property, plant, and equipment, we would balance it with a gain on sales of asset. However, this is the core business of this company, so we need to split it in revenue and cost of goods sold. So our revenue is the lease receivable because debit, receivable, credit, revenue. And the 300 remaining is our cost of goods sold. It's just like this equipment here is the inventory instead of property, plant, and equipment. And if we are talking about leasing companies, these are equivalent to their inventory. Okay, guys, so thank you so much. Subscribe our channel. You will be the first one to know when a new video arrives. Like our Facebook page, Accounting Hub by Dr. Scarping. If you have questions or comments, leave it here or email me at jscarping@gmail.com. Have a very nice day and God bless you.